Is the financial sector a very viable part of an asset allocation portfolio? Absolutely so, without a doubt. And trying to time that is really, you're just going to get yourself in trouble.
How should I approach the financial sector in light of recent banking sector volatility and the rise of FinTech companies? Joey, thanks for your email. So as we dive into the investment conversation, you think about Joey's question, and he's thinking about how to approach the financial sector. The financial sector is overall still strong. And in fact, with interest rates where they are, they have been cut late in 2024, but now we're talking about potentially holding serve a little bit on interest rates. And if they do go down any further in 2025, it would, take an external event that we're not really probably foreseeing at this point, which could happen, or it would be a more gradual decrease than I think many people thought at one point. So keeping interest rates elevated, John, I think overall that's the first thing I think of when you think about how should you view the financial sector.
Yeah, and Scott, I believe after what are we now, a couple of weeks into the Trump administration, I just believe you just don't know what's going to happen because it's really hard to it is a completely different world in terms of how fast the administration is moving on lots of different things and some of the dramatic things that they're trying to change. And of course, there's a lot of pushback on this and everything, but the political scene has never been more fluid, let's call it that. And, when President Trump talks about, well, I know more about interest rates than the Fed does, and I want interest rates to come down. Who knows how that has an effect on the bond market and all of that. There's just a lot of uncertainty about this. Now, the financial sector, I think, is very strong, and I think that there is a lot of pivots that the financial sector can do based on whatever comes out of Washington and politics and all of that. But I do want to point out, Scott, that investing in any one sector of the market is a little like trying to time the market and trading stocks. And it's really not something that we totally focus on. Is the financial sector a very viable part of an asset allocation portfolio? Absolutely so, without a doubt. And trying to time that is really, you're just going to get yourself in trouble. I think that financial companies are really in good stead. But I think that you've got a lot of things going on in the economy that can wrought some change to the financial sector. Mm-hmm. I think that when you take a look at the rise of FinTech companies, and the FinTech is short for financial technology. Just in our industry alone, technology is revolutionizing our day-to-day operation. What does that mean for us? What does that mean for GenWealth? It means that we can be more efficient. And theoretically, that means that we can be more profitable if we manage that the right way. And so when you think about how that kind of permeates through the financial sector, I think technology gives scale and leverage to the financial sector that we haven't seen in quite some time. Now, I also have a philosophy about technology, Scott, and this is one that, this is just totally my opinion. But I believe that technology is great, but technology can only progress as fast as humans will adopt it. And I think that tends to slow things down a little bit when you get some I'll go Alan Greenspan for a moment, some irrational exuberance about things sort of like NVIDIA. And, that stock was bid up incredibly so because they're just about in everything FinTech and everything technology-wise. But I think we have to sometimes think about this and go, okay, are we getting a little bit over our skis? And I think that happens both in technology as a broad sector and in FinTech as it relates to the financial sector.
And I want to get into that, especially as it pertains to AI, because obviously that was in the news earlier this week as well. I want to dive into that a little bit. But just to kind of wrap up on Joey's question, too, when he talks about the rise of FinTech, I think he sees that as a potential negative draw on the banking sector, because there is a concern with the rise of fintech companies that they might replace or supplant financial companies in serving the public. I don't really think I buy into that. I think that back to John's point, the adoption of technologies that help financial sector companies operate in a more efficient manner could lead to more profitability. That's our expectation here at GenWealth. So technology is not necessarily going to be a deterrent to the banking sector. It could be additive to the banking sector. And then one final piece, too, we talked about interest rates, but there's the other piece. When you mention the Trump administration, that also brought to mind the hope or expectation even of deregulation.
Yep.
And I think that's a piece, too, that would make shed some light on the financial sector in a good way, positive performance. But back to a couple of points here for Joey, and to wrap up the question before we go to AI, I think the thing that you have to keep in mind, as John talked about, is asset allocation, diversification. You can't afford, and I don't know that he's saying this in his email that he wants to, but you can't afford to go all in any sector of the economy or the stock market. You always have to have a diversified approach to reach your long-term financial goals. Stock market investing or stock investing should be seen always as a long-term process. Now, on a year-to-year basis, we use the terms, and this is what I think you should get used to too if you're listening, is underweight and overweight, right? Sometimes there is a lean, that's the way I describe it.
Yep.
There is a heavier lean towards something like a financial sector allocation or a heavier lean against technology. And that's where the help of a financial advisor can really help you determine on a year-to-year basis what small tweaks might need to be made to your asset allocation mix.
But those tweaks are not going to make or break you.
Right.
And that's how asset allocation is designed. That's what diversification is designed for, is to keep you from going all in and being, either it's win or lose and a zero-sum game, so to speak. Scott, let's talk about this whole AI thing, because that is just on everybody's mind. And, AI is used by a lot of fintech companies and can be leveraged really for, as we've said, greater efficiency and all of that. But in the financial industry, what AI can probably never do, and I'm saying probably never because I'm an old guy and I never would have thought I would have seen AI do what it's doing right now. So, for 20, 30, 40 years down the road, maybe it can do this. But right now, AI does not have the ability to employ empathy, judgment, or reason when working with people and their finances. What it does have the ability to do is to make what I call an A or B choice based on historical data that it researches and says, okay, this choice would be better than this choice. That's easy. AI is perfectly designed to do that type of work, but what it can't do is know you and know your goals and your vision for your life and your desires for your future and how that intersects with your money. The empathy and the judgment of a financial advisor, I think, will survive long after the new has worn off of anything AI.
All right, I want to, before we move on, have a little bit of a sidebar.
Okay.
Because we talked about this before we went on the air. So I want to pose this to you, because I was not in the financial services industry in the late 90s. But if you look at market performance in chart form, historical charts, certainly there are some comparisons that are visual to me and certainly being made by the experts that are out there, comparing where we were in the late 90s, which we were on a high and exuberance was high. Matter of fact, that's probably when Greenspan said that, right? Was
that's
roughly in that time frame, over the internet.
Right.
That was the technology of the day that was just launching and everybody was jumping on board. Compare that for me in your mind, having gone through that in the late 90s to where we are now with the exuberance over artificial intelligence.
I would like to think that we're a bit more smart and mature about this today than we were back when the internet was just kind of emerging. I can vividly remember being at home sick, watching Financial News Network and them talking about, well, we're all going to just be sitting around in our bathrobes and not ever having to work again. Wrong. That's not what the internet did. The internet actually enabled work and actually made more work for people, to tell you the truth. But I do also remember, Scott, that there were companies that made zero money, like no profit at all, and very little revenue, that had .com behind their name, and their stock price went to $200 a share or something like that. So yes, there was a lot of froth in the market back then. I don't see that as much today, but I do see people kind of getting a little bit ahead of themselves in terms of how fast AI can be adopted into the landscape and all of that. Most people think when things are going up, it's just going to be straight up to the moon, and it just doesn't actually work out that way.
Yeah, it always comes back to fundamentals, and with those valuations high, that means earnings are going to have to keep up and maybe catch up in some cases for the stock market on the tech side and the tech sector to continue to go. One final word about that. We know that many of you have heard the term deep seek for the first time in the last 7 days or so, based on what happened on Monday of this week in the market, and that's an AI type firm competitor from China. If you want to know a little bit more about what happened earlier in the week and what our thoughts are moving forward, I want to encourage you to sign up if you haven't already to receive the fastest 4 minutes in finance delivered directly to your email inbox every Friday morning. It's a piece that we do that is always topical to the markets, the economy, your money, anything related to retirement could be on that segment. And the reason it is called the fastest 4 is because we do it in 4 minutes or less. Usually it's going to come in around 3.5, generally speaking. If you would like to get that delivered to your email inbox every Friday, and we're not going to blow your email inbox up past that, it's just to subscribe to this one email per day with one email per week with the fastest 4 segment on it. Just text the word FAST to 501-381-5228. Again, the number is 501-381-5228. Text the word FAST, and we'll get you signed up for the fastest 4 minutes in finance.